Pankaj Pandey joins us now. Pankaj, good morning. Thank you for joining us. Pankaj, let's start with the sell-off in IT yesterday. Nothing wrong with IT companies, if at all. TCS, Infosys, Wipro, they are pointing to a better future, brighter future, margin expansion, hiring, everything which a shareholder wants to hear. IT companies in a sense have astonished us with that. Yet stocks yesterday sold off. How ironical is that?
So good morning, Nikunj. I think IT and pharma are the clear two sectors where the certainty of growth is far more better. I think even for weaker players also, we are seeing decent amount of traction. Say, take an example of Cyient. So while aerospace as a business is sort of declining for them, but overall you have communication and other verticals which are sort of pitching in. So despite the sort of sell-off, our sense is that we had seen a good amount of rally in the IT stock. And largely, it's a sort of a confirmation of a broader trend by most of the players that with more virtualization of business, you will see higher demand for cloud and cyber security, which is going to benefit almost all the players. So I think any kind of a crack like what we have seen yesterday, I think is a good buying opportunity. I think almost all the IT stocks are expected or can deliver 18 to 20% kind of a return on a one-year basis. Because I think from a growth perspective also, most of the stocks are going to deliver higher single-digit or low double-digit kind of a top line and bottom line growth. Mind you, we are yet sort of not quantifying the entire business opportunity because companies have been saying that the deal opportunity or the initial deal sizes could be smaller. So as and when sort of that situation becomes clear, I think IT as an overall pack is expected to deliver quite good. Whether it is a tier 1 player or tier 2 player. Now we have multiple companies that are trading at multiple different multiples. Say for example, Cyient, one of the weakest players, which is expected to witness closer to high single digit kind of a decline this year, is trading at about 8 times. But I think for the next 2 years, they are still sort of expected to deliver a decent amount of growth. So from that perspective, I think entire tier 1 and tier 2s in IT are looking quite attractive. And I think whatever sell-off we are seeing is more sort of a global sell-off. I think 6 to 10% kind of a decline ahead of US elections has been a sort of a norm except for 2008. So I think any kind of a correction should be used as a buying opportunity, especially for sectors where the growth certainty is far more better.
Okay, so Pankaj, which is the most attractive large cap IT stock to buy?
So I think within tier 1 IT stocks, I think Infosys is the most attractive one. Our sense is that their revenue CAGR and profit CAGR could be 11% and 13% respectively. And 1350 is our target price. So I think Infi clearly is going to deliver one of the best growth rates within the tier 1 player. So that way I think that's the topic.
Kunal, wanted your sense on what you're reading on what's been playing out in the Nifty IT index for the last 2 trading sessions. A, the reaction coming into Wipro's earnings and that serious bout of profit taking, which only continued yesterday. Do you sense that there's further pressure / profit taking which we're likely to see for Nifty IT majors? And the weakness unfortunately has been pretty much across the board. Mindtree, Coforge, all of them sank yesterday.
So, Aisha, last week I had done a chartbuster segment on the Nifty IT index, and I mentioned that the Nifty IT index is heading towards a major resistance on the RSI front. Now, the implication of that generally indicates, and these are long-term, medium-term to long-term kind of signals. And in the last 10 to 15 years, we've seen in 3 earlier indications of such kind of an overbought RSIs on the weekly charts for the Nifty IT index. Now, what does that indicate? It doesn't indicate that the rally is going to halt permanently, and you will see the Nifty IT index now trying to crumble under some severe selling pressure. It just indicates that there is going to be a pause. There is going to be a bump in along the way for the Nifty IT index rally, and that bump could probably result into different reactions for different set of stocks. So for the mid-cap ones, which have rallied up significantly higher, more than a V-shaped recovery, I think these stocks could go through a sharper correction. For example, what you saw for Mindtree, what you saw for Coforge, and a couple of these other names. For the large cap IT names, it could be more of a time correction and a mild price correction which could happen. And this, I think, this correction which could probably pan out for these stocks, whether it's the large cap or the mid cap IT stocks, could probably play out over the next few months. So I would sense that what we could probably see from the Nifty IT index is more of a time-wise correction. Some of the stocks can keep on moving up higher, but majority of the stocks would probably start remaining in a bit of a range. There could be more whipsaws which could happen into the Nifty IT index, and lack of clear direction into majority of the stocks. So I think that's largely going to be the texture of the Nifty IT index, at least looking at the historical comparisons on the RSI reading for the Nifty IT index. And we've also seen that whenever such kind of a time correction or a mild price correction happens, rather than getting nervous or jittery about it, I think long-term investors or long-term traders, they should try and take opportunity of these kind of sharp corrections. For someone who's missed out on the rally, or someone who's wanting to average out these stocks and was uncomfortable buying these stocks at their highs, I think these are good dips. So a sell-off in Mindtree, for example, in the last 2 days has been more than almost 200 rupees from its 2 days high. So I think those kind of opportunities are very good kind of opportunities for someone who's missed out on the IT pack.
Sure. Steel, that's going to be another space which is going to be in focus. There's an interesting note from Credit Suisse talking about the fact that post the hike this month, they say that Indian steel prices have risen about $20 to a ton and are now highest since the month of June in USD terms, with Chinese export prices now up $12 to a ton. In the month of October, domestic prices are still at a 4% discount to the landed Chinese imports, clearly indicating there is further headroom for steel prices to go up. Pankaj, some enthusiasm has already played out in metal prices, but not a very big conviction call from a long-term basis. Do you sense that the metals trade can hold through for some more time to come?
Well, near term, yes, probably given the capacity utilization for leading players, the numbers are expected to be good. But I think steel or metal per se is a sort of at best a trading buy. Beyond that, I think one should not be reading too much into it. I think structural buy will happen only when you see high cost of players moving out of business. The challenge is that most of these players are again supported by government, whether in India or whether globally, especially in a key market like China. And we've seen the raw material prices inching up, and then that sort of led to shortage of iron ore, and as a result of that, China had to sort of import some of the semis, of which India participated last quarter. So I think it's more of a sort of a trading buy. I don't see anything structural in the metal as a pack. Until the time the high-cost players get out of the business, that is when the demand supply structurally will get restored.
Let's now go across to Ruchi. She's got some exclusive details on Concor, a revised land licensing policy up for Nods as it has limited the Concor divestment process. Ruchi, take us through.
It looks like the government is all set to move with the privatization process for Container Corporation of India. The government was keen on selling their stake in Container Corporation of India in a bid to privatize the company. Now we're given to understand that one of the big overhang for the stock was the land licensing policy. In fact, investors had also raised concerns with respect to the land licensing policy. We're given to understand that the government has been able to reach a middle ground with respect to the land licensing policy. Remember, Finance Ministry had proposed to the Railways Ministry that land leases must be given on a long term. In fact, had also suggested that the land licensing fee should be reduced significantly. We're given to understand that Railways Ministry has agreed to some of these recommendations. In fact, the policy by the Railways Ministry will be up for a cabinet nod very soon. In fact, in a month's time or so, the sectoral policy for container freight stations will be a big shot in the arm for the privatization process for Concor. As I said, this was a big overhang and now will be up for a cabinet nod, has been sorted out. The government will put out the expression of interest for Concor by the end of November.
Okay, thanks for that, Ruchi. CK, from the broader markets then, anything else on your radar you'd like to point out?
Well, I think markets are, a little bit spread out, and after the big drubbing that many of the stocks took yesterday, I think one among the few stocks which managed to withstand the selling pressure was Cummins India, and Cummins has retreated down into intraday support zones during the fall of yesterday, which was quite limited in terms of what impact it had on Cummins, and on the daily charts it's on the verge of staging a push past near-term resistances, which shall succeed if the stock starts trading at or above 450 levels once again. So I expect that to happen with the market reviving. So Cummins is a low risk buy with a stop which should be placed somewhere around 435.37 and a target for the day at 455, but if it closes there, then that would be a good signal for further gains to be made as well.
Kunal, what about you?
Well, I think one of the stocks which did reasonably well for a good part of the session yesterday, at least the first half, was Tata Chemical. But in the last half an hour, last 1 hour, I think many of these stocks started to correct and fall under some severe selling pressure. But I still believe that the chart patterns for Tata Chemicals are quite strong. The stock has now come back to a retest of the neckline of this double bottom kind of a pattern on the hourly time frame. So I believe that this could be an interesting buy on Tata Chemicals. At current levels, the short-term charts indicate that the stock could head towards at least a target of 324 and stoppers could be kept at 307.
Okay. Now the big bull has kept his faith in the Tata pack intact. Let's take a look at his views on the group. They remain upbeat, of course, despite all the pain. In fact, back in 2018, he was also very positive about the group companies delivering value. Listen in.
They are my role model in life. They're the persons who established the house of Tatas, Sir Ratan Tata, not this, and Sir Jamshedji Tata. They willed all their wealth to charity. And do you know one thing, the Tata Cancer Hospital in Bombay, every child who comes to Bombay is examined by them. If they feel they can cure it, they give free treatment. The Indian Cancer Society gives medicines. Now they're setting up a cancer hospital in every district, in every headquarters in India. Who set up India's first steel plant, first hotel, 5-star hotel, first power plant, first software company, first car manufacturing company? Who set up the Indian Institute of Sciences? Who set up the Tata? So it is a role model of what is wealth. They are creating wealth for the good of society. What greater noble aim can a human have? Right? So they are my role model in life, and I think Mr. Chandrasekhar is God's gift to the house of Tatas. He's a man who doesn't call the lion, he goes to the lion's den. He understands, and although he's an engineer, he understands finance better than us.
So which Tata group of company do you think can be the star now next 5 to 10 years?
I know about 10 years, next 5 years I think Tata Steel, Tata Communication. Two companies,
Two companies, okay. Are you happy and satisfied with the policy Chandra is taking to reboot?
Not happy, very, very happy.
Why do you say that?
Because he's actually consolidating the group, affecting on cash flows, demanding performance, rewarding performance. I think taking the right policies. I am very, very happy.
Tata Motor is yet to recover. TCS is on autopilot.
Recovery doesn't take place in 2 months. I think the worst for Tata Motor is over.
Would you say the group to watch out for next 5 years? We're talking 5 years and 10 years. The decade has started. Could be the Tata group.
Well, they're going to do well. I don't know with other groups. Tatas are going to do well, that I can say.
There's a change of guard at Titan.
Yeah.
Does that bother you?
Not at all. I think the successor, of course, to have a successor to Mr. Bhaskar is not easy. But I think Mr. Venkat, who's successor, is extremely competent and good.
Well, the breath yesterday just got chopped, and the point I want to make here is, in last 1 month, Nifty is up 1.3%. Now, whether it's IT, whether it's Reliance, doesn't matter. The net impact is Nifty is up 1.3% in last 1 month. But during that same time, small cap index, hear me out. The small cap index is down, there you go, I'll refer my screen to my sheet. Down 5%. During the same time, the mid-cap index is down 4.5%. So just when it appeared in September that the broader market will come together and the building blocks were coming together, it's got challenged. So October has really poured cold water on all chances of an extended purple patch for the mid and the small cap space. Pankaj, what is your view on some of these defense players? Suddenly BEL, HAL, BEML, they've lost luster. A BEL is down from 120 to about 80 rupees, 90 rupees. HAL is not going anywhere. BEML is not going anywhere. When the Atmanirbhar campaign was announced and when government put about 100 items in the import restriction list, everyone thought that this is the space where you need to be because the business was guaranteed and the business was protected by the government. But why are these stocks suddenly fallen off the radar? Even something like Mazgaon shipyard never saw the excitement.
Correct, Nikunj. I think, the challenge with most of your defense PSUs is that these players get contract on a sort of a nomination basis. Largely the margin corridor is well known. And again, the challenge always is that on a structural basis, it is very difficult to sort of comprehend what will happen 5 years, 10 years down the line. And also it is again subject to other variability in terms of whether the government will be sort of pushing in terms of capex. I mean, Cochin Shipyard is a classic example. We've been covering that stock for a good period of time. The stock looks good, but the challenge is that we still don't have clarity on this other or the new aircraft carrier, which was expected to sort of come up. So they've been finishing the existing one. Then you have ship repair business, which looks attractive. But then again, I think the challenge always is that you are still not sure structurally whether you can sort of pencil in growth 5 years after 5 years. So which is where I think the challenge for most of these defense PSUs. And all of them are sort of trading at attractive valuation. I think the challenge lies is we are still not sure 5 years down the line whether they'll have contracts and what would be the flow of that. So I think that is where the bigger challenge lies.
Thank you for that. Okay, Pankaj, now let's talk about stocks which in a sense have puzzled best of the fund managers. One is ITC and second is Bharti. What has gone wrong with Bharti and why is ITC, despite being cheap, zero debt company, it's a company which essentially generates a lot of cash. The cash they generate is more than a lot of FMCG companies put together. They are just getting beaten. They're getting beaten both black and blue.
Correct, Nikunj. So I think in ITC, so they have addressed some of the challenges in terms of not putting money into low ROAS businesses like hotels and looking for a higher dividend payout. But I think within the FMCG is the business which is sort of attractive the most. But then again, the challenge with FMCG is that once you sort of look to scale up the margins, I think that is where the clarity needs to sort of emerge. Because at this point in time, you're sort of gaining market share or doing well in terms of revenue. But then again, in terms of margin, I think things need to be improve far more significantly. I mean, take an example of, say, noodles. So noodle is a very high ROAS kind of a business compared to Atta, which again is a sort of a low ROAS kind of a business. So from that perspective, I think for ITC, till the time the margin trajectory does not improve, I would still expect the stock will remain at 15, 16 or at least 15 to 20 kind of multiple. So challenge lies, so some improvement, but challenge still lies for ITC. I think for Bharti, we are hopeful that you will see a price hike happening, but then again, I think probably market is still not sort of convinced. We'll have to revisit our expectation in case if the price hikes do not happen in Q4, because our sense is that without Voda or with Voda, Bharti was expected to do well, given the fact that it is sort of pretty well capitalized for the competition. But then again, I think price decline has been sort of a bit of a puzzle for us as well. But in case if the tariffs don't get hiked in Q4, then I think we'll have to probably revisit. Then probably the stock is going to remain in a range, and we'll have to revisit our bullish expectations.
Okay, that's the take coming in and what the texture of the market is likely to be. A 2.5% fall is what we stared at yesterday. Gave up a 300-point gain in just a single day itself. A 1,000-point fall coming in for the Sensex as well. And all sectors bled. Yes, there were the globally linked sectors which really took it on the chin. What with the move coming in IT as well as financials. And then, of course, the breadth of the market as well was quite dismal in trade. The other stock which really one sat up and take notice of was Bharti. And Nikunj, now Bharti is, standing sub 400 for a name which has the most biggest consensus call on the street. Just about every analyst tracking it has got a buy call on it. Pankaj, the same question to you. What explains this stark underperformance from Bharti?
I think Bharti is trading at nearly 50% kind of a discount compared to CGO. But I think the challenge again, or where probably I think the trigger for the stock could be if we see a tariff hike in Q4. So that's a sort of a key assumption what we are sort of penciling in. And in case if that does not pan out, I think that is where probably the challenge would lie for the stock. And I think till that time, it looks like that the stock is going to remain in a range. Despite the fact that it is attractive, it is well capitalized to sort of take on competition with Voda, without Voda, I think it is still attractive. So even for us also, it's a sort of a challenge given the fact that we were quite bullish on this particular stock. But then again, I think the price performance is sort of contrary to that. So we are hopeful that things would sort of normalize in Q4. You'll see price hike. In case if that does not happen, I think we'll have to revisit.
Yeah, absolutely. Kunal, the same question to you. The fact that Bharti has now breached even the 400 rupee per share mark, what is it telling you about the stock? Is a rebound anywhere in sight, or would you say that this could even fall to the previous level from which it actually overshot that of 320 thereabouts perhaps?
So, Aisha, typically what happens is stocks go down or go up on two reasons. So, for example, in Bharti Airtel, stocks go down two reasons, either when there is fresh build-up of short positions or there is complete lack of buying which happens into the stock price. Now, for Bharti Airtel, I think it's the latter which I think has been playing out. Now, when I was looking at the data for the last 1.5 or 2 months, where the price fall has gotten a bit accentuated, there is hardly any build-up or skewness or the tilt for traders in terms of building up of open interest on the Bharti Airtel. So, the average OI for Bharti Airtel remains at 66,000 contracts or 67,000 contracts. There is a mild change, 150 contracts or 30-40 contracts on a daily basis, which happens, which is very, very minuscule. Then you look at the last 1 month's price performance of Bharti Airtel. I think from 520 odd, start of September, the stock is now, sub those levels. So there is no, indication of, fresh selling or shorting which is happening on Bharti Airtel. I think this is more a delivery-based, selling which happens on Bharti Airtel. And to counter that, there is not too much of buying which happens. So the average volumes on the daily charts have also dropped for Bharti Airtel. Now, when you look at all these data points, it indicates that till the time there is no fresh buyers or fresh buying which happens into the stock price, it's difficult to ascertain the supports for Bharti Airtel. The stock may remain in a bit of a limbo. It could continue to go towards a downward drift yet again. It can probably touch even a 380 mark or a 350 mark as well. It all depends on how the selling whether the selling gets aggravated or not. But I think the bigger question is that because of lack of buyers, because of lack of buying which is happening into the stock price, it's unable to find a credible short-term bottom.
Okay, let's also go across to Vinny for some khabar on D Street this morning. Vinny?
So we do know that how during the lockdown most companies had stopped giving trade margins and offering margins to their retailers, mainly due to the impacted sales as well as store closures. Now, however, as we are seeing recovery in operations, sales volumes coming back, companies have started offering retailers their margins, and this is mainly to boost the sales, and this strategy is coming in right before the festive season. So companies are now said that consumer channel checks are suggesting that consumer goods companies will now be focusing on offering more benefits to retailers as well as consumers. And how will they be giving these benefits? Obviously for retailers via trade margins and consumers via discounts and promotions. Now where is this money going to be coming from? Will this be impacting the margins? So according to channel checks, it suggests that they will not be impacting the margins much, mainly obviously due to because consumers will be removing the consumer goods companies will be removing this amount from the marketing spends, ad spends. They're going to be looking to cut back on those, and they'll be offering these benefits to retailers and consumers. Obviously this is only the main reason is because the demand had been quite stagnant for a bit. So to promote the demand, push the sales, this is coming in at such a time, and overall sales are also recovering for consumer good companies. We've seen that demand is coming back to pre-COVID levels, so trade margins are also increasing. Now where have they increased the trade margins? For soap products it's 3 to 4%, while for other personal category products it's 4 to 5% is what we're getting to understand. Now GCPL has increased its margins on soaps to a tune of 3 to 4%, HUL has increased to 4%, and this is for SKUs on some SKUs on the Soap Excel Easy Wash side. So that is where they've increased the trade margins, while in terms of Marico also they are offering higher incentives to retailers. Now one factor that we do have to watch out for is normally when leader companies do increase the trade margins, the mid-tier companies have to increase it by a bit more, so they offer higher margins obviously due to the competitive intensity. So due to this, we will also have to keep an eye out for other mid-tier consumer good companies of how they are increasing their trade margin, and that will be interesting to see what actually plays out for these consumer good companies now.
Okay, HCL Tech numbers on your screen. PAT coming in at 3,150 crores. That's versus 3,033 as per expectation. So it's a beat on first glance. Still waiting for some of the other major headline numbers to come in, but this is a good start for HCL Tech. Remember, we've had a season of very positive IIT earnings and expecting to see some of that reflected perhaps in the reaction today. We're heading into open anyway at the moment, so we'll wait and see after that cool off yesterday how the market responds to these earnings this morning. But a beat on first glance, 3,150 on an HCL Tech. I'm just waiting for the other numbers. We don't seem to have them as yet, but they'll be coming up any second now on your screen. So no surprises really there, Nikunj, in terms of a performance, meeting performance from an HCL Tech. They have been consistently delivering, and it seems that, once again, that they're just, they're actually kind of sort of meeting expectations. Let me get a view as well from from our panelists and get a sense from them as well on how things are looking for an HCL Tech in particular. Pankaj, what's your view? First take on the numbers. I know it's just the headline figure right now, but I'm sure the other numbers will be coming in just as we speak.
So in HCL Tech, we were expecting sort of a constant currency growth of 3.5% and dollar revenue growth of 4.8%. So I'm not sure the kind of numbers. Along with margin expansion of 80 bips. I think this company is a good play on cloud business and trading at 80-90 times, similar kind of what we are seeing in Wipro. But compared to Wipro, this is expected to deliver far more better growth. So my sense is that within tier ones, this is also expected to sort of keep doing well. So I can't sort of comment on numbers, but overall, I think the numbers are on these lines. I think we will continue to maintain bullish price.
Q3, Q4 revenue to grow at an average of 1.5 to 2.5% in constant currency terms. Madhu, matches up with your expectations, HCL Tech?
Yeah, it is kind of in line with estimates on revenue side. Revenue is a modest bit, but margin there is an upgrade in the guidance. So that way there could be some earnings upgrade as well. But overall, this is still a reasonably valued stock, around I think 16 times 2-year forward earnings. So it's a almost like 35% discount to TCS. And on a full year perspective, could grow revenues by 1-2%. So I think that way, with the kind of valuations it commands, I think it's a decent stock. So we actually have a target of around 930 rupees. But also see the contest. I mean, sometimes once they gave the result, pre-result, 15-20 days ago, I think the stock is up from 750 to 870 already. So today, obviously, there could be some up move, but I think the event is now priced in. Because they already gave a pre-result indicator, right? To the exchanges on September 15th.
If we can just bring up that guidance. Yeah, true, absolutely. That's when they had actually indicated what they're likely to do going forward. Can we just bring up that guidance point again? I just want to quickly go through that. That will just come up for you on your screens because I think the guidance figure is out and that is what the street is going to be analyzing the numbers on the base of. Q3, Q4 revenue is going to grow at an average of 1.5 to 2.5% in constant currency terms. They see FY21 EBIT at 20 to 21%. So that's the kind of guidance that's set out. In the interim though, Madhu, what one is seeing is that IT is turning out to be more a flavor of buy on expectation, sell on news. In that anticipation and the kind of valuations that HCL Tech as well has been quoting at, do you sense that it's going to be a more simmered reaction when the stock markets open today?
So that is what I was saying. I think when they gave it itself, it was at 750 when they gave the pre-result on September 15. From there, obviously, it has had a good rally. So we have seen that with Infosys also yesterday. So I think there could be some up move, but after that, we have to see. And one more thing you can see that all companies have shown good margin beat because of the work from home led, the cost savings as well as higher offshore shift and all that. So gradually next year you can see that clients might ask for some discounts because initially the first 6-7 months you will enjoy the benefits of all these short-term gains. But gradually that gets passed on to clients. So that also can lead to some, tapering off on the pricing next year. But that's more of a subjective call.
Quick chat. We just have the guidance figures as of now and of course the operational details. We're looking at waiting for details on pricing, the deal momentum, what is the outlook across verticals, capital allocation. That's going to be really key. What is it that you're going to do with cash in their coffers? Is it buyback that they're announcing? And then of course the attrition levels. Remember Infy as well was the second one in the tow within the IT universe to actually announce salary hikes. So all those kind of parameters we are still awaiting from HCL Technologies and of course the cloud-led adoption as well. Where do they see their digital revenues headed? But that in just a bit, counting down for the market open. Nikunj, it is a shaky landscape that the markets have fallen into, at least yesterday's move has totally changed the dynamics. And what we were chatting about last afternoon as well, that the weakness has been largely led by the globally linked sectors. That's IT as well as financials.
Yeah, weakness or profit booking, two different words. Profit booking is a function of pure skim from the top. Weakness sometimes is a function of something going wrong in terms of the market dynamics. I guess the profit booking is the right word which describes yesterday's sell-off, at least in large cap IT stocks. For me, IT and pharma along with specialty chemical, they are in a leadership position because it's a matter of growth. If markets will shift wherever there is growth and where there is near-term visibility. In IT for sure now is giving you not a near-term visibility but a medium to a long-term visibility, which means that for next 2 or 3 years, it's a matter of growth rate now. IT companies will grow. They will grow. There is no leverage. IT companies are doing buyback and their margins are strong and work at home has been adopted. So that is the new normal for IT which we must recognize and accept, and that's what markets are rewarding. What happens in the IT space in the short term of course is a function of technical and profit booking and a lot of other factors. First rates, Friday morning, it's been a okay week. We started the week well, but then came yesterday's big smashing price action. HCL Tech, buy on rumors, sell on news. How many times we've said that? Well, let me say it again because it is applicable. 5 rupees down for HCL Tech. It's not like a sell down like Wipro or Infosys, but yeah, it's not a great start to good set of numbers because they shared their outlook much ahead of the time. Advanced decline ratio for a change is looking much better than what it has looked in a really long time. You got to start with Bharti, and because that in a sense broke the back of the market in the second half of trade yesterday. A stock which was at 550 plus has come down to levels of 400. The most concentrated trade in Indian stock market, Bharti, has reversed completely. Banks are bouncing back, but this is a very dinky bounce, 1% here, 1% there. Well, Rakesh Jhunjhunwala now owns 1% of Tata Motors, large investment, very large investment in absolute terms now. The stock is reacting, it's at 130. IndusInd Bank 607, Bajaj Finance is bouncing back, Tata Steel, and I also want to mark out HDFC Bank. So it's a good start, it's a decent start. Let's go back to HCL Tech once again. Established Infosys and TCS, have they stabilized? For me, Aisha, the moment I look at the market breadth, I think I'm getting an answer here that the market breadth today is much more powerful than what we've seen in a long time.
Yeah, the breadth of the market is definitely 113 stocks within the F&O universe standing to the advances. It's much like an opposite picture from what we were staring at yesterday. 14 stocks though still to the decline. It's Escorts which is powering ahead 2.25%. Ashok Leyland, remember Monday as well turned out to be a great session for Ashok Leyland. Saw some follow through price action the next day as well, and today too Ashok Leyland is a mover. There's Voltas which has sprung up right to the top. That ban on AC imports is auguring well perhaps for the sentiment in this one, 2.5% higher. There's Piramal Enterprises, LIC Housing Finance, MGL, Concord. This is the texture of the market as we speak. Within the Nifty as well, you're seeing a bounce come in for both IT as well as banks. HDFC Bank, ICICI Bank, Bajaj Finance, Axis Bank, Wipro, Techem, TCS, Infosys, IndusInd Bank, they're all the leaders and they contribute to the top 10 Nifty movers this morning. You've of course got a good move coming in Tata Motors. I want to quickly see what HCL Tech as well is up to after what looked like a bit of a tempered start. It's finally beginning to pick up just that wee bit. Along with HCL Technologies, you had good numbers coming in for Cyient as well. Margin surprise as well was there. The management outlook for second half is positive. But the management says that Q3 is going to be weak on the A&D business. So that is the only catch point here. Let's see what Cyient as well is up to, considering it's not just about large cap IT names, it's mid cap as well, which has been holding up. 2.5% higher for Cyient as we speak right now. Then of course, let's also look at what some of the other result contenders are doing. Federal Bank, remember, is going to be first from the banking pack, which is going to be delivering its numbers today. So that's going to be key. We've already seen as to how the shine of gold has rubbed off on Federal Bank for the last 2 quarters. So let's see whether the same momentum actually continues for Federal Bank today as well or not when it reports its numbers. And then of course tomorrow you've got the big boy HDFC Bank as well delivering its numbers. So keep a lookout for what HDFC Bank as well as HDFC both do in trade in terms of a market texture, and of course for HDFC Bank ahead of its numbers. So net, it's not a bad start, Nikunj, but given the kind of intraday volatility that we've been marred with of late, I just hope that these rates sustain, if not build on from here.
Well, sustainability, I guess, is clearly important. I just want to, bring out, and the stock popped up on my screen, so I connected the dots. Companies like Gujarat Fluoro and SRF would also benefit because of the entire ban on imported ACs. Because while there are manufacturing companies like Voltas who will benefit, or Blue Star would benefit, but AC is a complex machinery. There are the equipment manufacturers who are also suppliers to the air conditioning industry, the second derivative, Gujarat Fluoro, SRF. It may just be a trade for the day, and that space definitely warrants a revisit. Rajiv Thakkar joins us now. It's good to connect with you, Rajiv. I was looking at your term sheet.